Hello everyone, and welcome to our webinar today. We're going to discuss about digital financial services and how continuing progress at your institution on the digital sphere. We're very happy to have back our amazing Andrew Lake. So thank you, Andrew, for being here and leading this. I want to let you know that we're having upcoming webinars, or just one more for this year, on the performance measurements for SME banks. That's going to be in October. And then we're going to pick up the webinars next year. Andrew is our CapPlus digital finance service expert. He has more than 19 years of experience in the digital financial services. Prior to joining us, he was the global digital service specialist with the IFC. And he has guided many banks, NBFIs, microfinance institutions, as well as many fintechs in the development, improvement, and implementation of their digital strategies in a lot of different areas of the world, like Middle East, Africa, Asia, and Eastern Europe. Prior to joining the IFC, Andrew started and managed 2 full commercial mobile banking operations, one in South Africa, the MTM banking, and one in Bahrain, known as Zain, Me to You. So Andrew, I'll leave the floor up to you.
Thank you, Elkis, and thank you, audience, for listening to my presentation. It's good to be back. We'll start today with a quick recap of digital, what it means. Then we will talk about what is happening in the industry out there. We'll then speak about what is happening in the access to finance space, specifically in East Africa, and then financial health, which is the new trend in digital. In a nutshell, digital is about using existing infrastructure, people's existing phones, their existing internet access, their existing PCs, to deliver better, more cost-effective, broader-reaching, and financial services to the market off a much lower cost base. This is both an opportunity and a threat to existing financial services company. It's an opportunity in that you get to operate a lot more closely to your customers, to satisfy their needs more comprehensively. But the threat aspect is that it has opened up the market for some fairly substantial competition, particularly from the telcos, but also from retailers, etc. So as I say, it's both an opportunity and a threat for a financial services company. So what is happening out there? The industry, the digital financial services industry, has basically been developed in two phases. Access to finance, which was all about the establishment and rollout of digital ledgers and payment and remittance systems. The rollout of phones and cards as transactional devices, particularly relevant in developing markets where electronic payments were not very well developed. The establishment and rollout of agency networks, which allowed stores and kiosks to become small-scale bank branches on a distributed basis, sometimes very substantial customer bases. I've got a slide on where I describe what very substantial looks like coming up. And it tends to be based on a one-size-fits-all product. So in other words, there is a single transactive account referred to as a wallet. It's really a current account, but the use of the word wallet was included predominantly for compliance reasons. And effectively, that one product is offered on a knock-and-drop basis across the entire market. Financial health, which is the emerging trend, is about taking those, let's call them emerging financial relationships, and expanding them by homing in on what really matters to clients by segment. So it's about contextualizing the existing access to finance infrastructure needs of very specific segments such that it becomes indispensable for them. And in so doing, grows usage. So access to finance effectively opened up access to millions of customers, and now the world is moving on to making sure that those who've taken up the services can see value in what they've got and start using them more extensively. The development community is basically treating access to finance as done. They regard the rollout of ledgers as pretty much complete. We don't agree with that for a number of reasons. One is many of the banks did not take the first wave seriously enough, and have found themselves left behind. So they need to act quickly to play catch up. There's some very substantial bases being developed in markets where there are many markets now where one telco controls a customer base which is bigger than the entire banking sector. Pakistan is an example, Kenya is an example, Uganda is an example. So the banks in those markets have realized that they need to take this seriously, and they're playing catch up quickly. There are still new telcos, new retailers entering the market. So the market isn't settled, but it is settling. And if one is going to play in this market, now's the time to jump in. As I said before, financial health is really about taking existing infrastructure and contextualizing it to the needs of the market. And it is seen by the development community as where they're going to place their emphasis. So if you've missed the access to finance boat, best to catch up, because as I'll discuss further, it's going to, the gap between yourselves, the digitally enabled and the non-digitally enabled, is going to get bigger now with financial health coming. So what does it look like? Well, this is what mobile money looks like in 2018. This is for the 2017 year, but published in 2018. We're effectively looking at 276 mobile money implementations globally, of which 47 have more than 1 million customers. Now, to break even on service fee income alone, a mobile money operation needs about 500,000 customers. So those 47 with more than 1 million customers are very profitable just on service fee income, which makes them sustainable. We've seen a 25% growth year on year in the customer base, rising now to 690 million people. Mobile money has grown its base by 25% in 1 year, so we're in the exponential growth phase of mobile money, and the industry as a whole has shipped more than $1 billion per day in transactions that are affected. So we're looking at a sustainable business which is here to stay. I don't think anybody should be under any illusions that the telcos are going to pull out of the mobile money space in the near to medium term. It is too strategically significant for them. So I think one should take the view that they're going to be with us for a long time, and work out rather how we work with them rather than hoping for them to depart. What are the banks doing? This is the base of the DBR research, looking at what is most important and what is top of mind for CEOs. I've been told that some of the screens that are being used around the world are fairly low resolution, so maybe you won't be able to read the descriptors next to those graphs, but not to worry, we will be sending you hard copies of this presentation where you'll be able to read it. Basically, what is top of mind are things like removing friction from the customer journey, using big data and AI and advanced computing for lending, and improving integrated multi-channel delivery. If I were to sum it up, perhaps on this next slide is the best way to look at it. 10 of the top 11 items on the retail banking CEO's agenda right now are digital. The one that is not is regulatory, although I could probably argue that at least 50% of the regulatory compliance issues with which they are dealing are related to digital banking. So maybe 10.5 out of 11 are digital, but certainly at least 10 are. So I think we need to, it's clear that digital is very much on the agenda. So in summary, what are we saying? Digital is at the forefront. We've reached the point where about 1 in 10 humans globally uses mobile money. 47 operations are very profitable on fee income alone, and they're starting to lend and they're starting to take savings. So for them, the balance sheet revenue is cream on top of their core revenue, which comes from service fee income alone. They're also getting heavily involved in cross-border remittances. There are hubs forming, certainly within Africa, and they're going to roll into Asia, where international remittance will become as easy as a few clicks on your phone too. So in fact, it's already the case in Africa. Asia is catching up fast. Digital holds the potential to consolidate the retail banking sector, and I think we need to dwell on that for a little bit. A typical mobile money operation, the GSMA tells us a typical mobile money operation consists of a telco and 7 banks who are holding the funds and managing on their behalf. The truth is that in many of these instances, it's more like 3 chosen banks and 4 who are just on the panel. In many cases, the telcos have 1 chosen bank. So effectively what we're dealing with is a structure where the banking sector is being concentrated into a very small number of banks. And in fact, in many instances in the countries that I listed earlier, where the mobile money operations are bigger than the industry as a whole, you are ending up with more customers concentrated into 1 bank, albeit via an intermediary, than exists in the banking sector and formally acknowledged to the central bank. If a bank is not on the panel of one of the mobile money operations, there will always be a role for what I call wholesale retail banks, which sounds like an oxymoron, but it's not. What I'm talking about is effectively banks could decide perhaps to focus rather on being a product house rather than being a customer owner and manager. And then offering bank financial services through the mobile money operations to the customers without having to incur the costs and the complexity of actually managing the customer base themselves. Of course, that has ramifications for the bank's brand, and it has ramifications for the strategic positioning of the bank, but it is a possibility that could be explored. As I said in my previous slide, many banks have seen the challenge and have focused in on digital and are building competing products. These are the banks who have decided to stay in the consumer-facing space and have decided to win their customers back and or consolidate their position in the customer's mind. As CapPlus, our focus is on supporting this last category of banks, the banks who have decided to take up the cudgels and defend their position, because we still believe that there is a strong potential for the banks to retain control of the market. The point is that we just need to jump in and start doing it now. The time is getting tight in terms of implementing. In support of this, there's been a shift from access to finance to financial health, which is how well people are serviced financially. They're actively using and benefiting from the products that they now have. Very important to be able to become involved in financial health. A bank's going to have solved the access to finance issues, because providing people with enhancing and segmenting a digital service for the needs of customers implies 2 things. It implies that you have a digital service, and it implies that you have customers already using that digital service so that it can be customized. So for banks who have not done the access to finance portion, or the access to finance portion is still some way off, there is an opportunity now to quickly play catch up on the customer servicing side of the business. Others may wish to explore buying up and or merging with the existing players. We definitely see a scene for mergers and acquisitions in the near to medium term in retail banking in many of these developing markets. So our first feedback session, if you were to look at your organization and say, we are somewhere on this road to digital, if you look down the bottom right-hand corner there, it says that answer number, we're trying to position where the audience is on digital. So are you still looking at it? Your answer would be 1. If you're developing an access to finance infrastructure, i.e. a wallet and agents, etc., then you'd answer 2. If you have access to finance infrastructure built in operation, it's 3. 4 would be access to finance done and growing nicely. 5, considering financial health. And 6, have built financial health. If you could enter in the poll now.
Thank you, Andrew. We'll wait to get some answers to this quick poll, and then we will share the results. And you can see where our audience stands on this, and we can comment a bit about it. Answers are coming, so we're just going to keep the poll a bit more open, and then we can have the results. I think we can close the polls now. Great. So Andrew, we have like a bit of a mix, but mostly it's like 1, 2, and 3, I guess. You can take it from here.
Okay. Guys, if you're still in the access to finance phase, we strongly urge you to focus on building that and getting it ready, because the next wave is going to create and exacerbate a digital divide between your banks and the next layer. At the end of this presentation, I'm going to take you through an example of what financial health could look like, and you'll start to get a sense that the banks who are in it are going to own the customers, lock, stock, and barrel. So you need to get yourselves relatively soon into a position where you can be a participant in the financial health initiatives, so that you can lock yourselves in to your customers' lives. But we'll speak more about that later in this presentation. Okay, so let's speak a little bit about East Africa and what has happened in the access to finance space, just to put it into perspective for you what is happening. I have chosen East Africa simply because I could get data that was comparable between countries. There's no real sinister reason. It's just that the Gates Foundation has done some really good research in East Africa. They're busy ramping it up in West Africa, and they're going to do it in Asia too. But for the time being, there's data available in East Africa. Not all countries are the same, not all regions are the same, but the global trend, East Africa has led the way in digital thus far and continues to lead the way. But the rest of the market, I believe, is going to look similar in the near to medium term. So let's dive in there. Again, I know many people are looking at this in low resolution, so again, this presentation will be shared with you afterwards. But if you can see, basically on the next few slides, I'm comparing 3 countries: Uganda, Tanzania, and Kenya. Each of them has 4 little graphs. The clusters of graphs, for if the resolution is really low and you can't see it, on the left-hand most cluster of graphs in Uganda, for instance, refer to the non-bank financial institutions. That's their market penetration across 4 years: 2013, 14, 15, and 16. The next one is the banks, the same thing, and the next one is mobile money. So it goes NBFI, then the cluster, the second cluster of 5 years is the banks. The next cluster of 5 years is mobile money, and the fourth cluster to the right is overall. If you have a look, this page refers to access and trial of financial services, i.e., piece of market research of statistically significant market research was conducted in each of these countries, and the respondents were asked, do you use, if you were going to try a product, a financial services product, where would you get it from? Would you get it from a non-bank financial institution like a microfinance institution? Would you get it from a bank? Would you get it from mobile money? And then there's the country total off to the right. You will see that on product access and trial, mobile money is walking away with the market. You're looking at approximately 5 or 6 times the trial rate as is being done through the banks, and approximately 10 times what's being tried with the NBFIs. That's in Uganda. But if you just look at all the markets, you'll see that the trend is pretty much identical. The new trial is going to mobile money, and the volume is going to mobile money. Registered users, you'll see the trend is the same. We have effectively a situation where the people who are trying the product are converting to mobile money. You'll see 40% of the respondents have actually registered, whereas 60%, for instance, in Uganda, in the most recent year, were trying it. 60% of those who tried it actually opened an account. In Uganda, Kenya, and Tanzania, it's pretty much the same, and they're outrunning the banks. And active users. Now, active users means the question that was asked was, did you use the product in the last 90 days? You will see, if you look across all of the industries again, mobile money is growing its active user base. The bank's user base is in decline, as is the non-bank financial institutions. The market wants, what this is saying to me is that the market wants a right here, right now service in their pockets, delivered to them in a mechanism which they themselves choose. This is one of the reasons why I say we need to, if you're an institution who is somewhere along the road towards access to finance, you need to solve the issues and be a player in this market if you want to retain customer attention. If you strategically decide that you want to veer away and sell your products through the mobile money operators, that's a different value proposition entirely, and it involves a different approach inside your business, but it is definitely a valid route forward. But if you want to remain relevant in the customer-facing space, what these graphs are showing is that you will need to go digital. You need to get onto the guys' phones. You need to get onto their internet browsers so that you can start capturing this market. A summary for East Africa. Mobile money stands head and shoulders above the banks and the NBFIs in terms of client reach. In all of these countries, if I'm not mistaken, the mobile money business is bigger than the entire banking industry in terms of customers service. Yes, the high value individuals are still with the banks, and I think the mobile money operations will battle to lure them away for their core banking relationship. But for normal consumer markets, which are the markets which we as development organizations are interested in, they are busy moving into mobile money with the telcos. So we need it for the other institutions who like the microfinance organizations who have traditionally been servicing these markets. We need to ask ourselves, what are we going to do to make sure that we remain relevant as this market emerges? Okay. If one were to take a view on the current development of East Africa, and one said, okay, I have a financial services product I want to sell, the same suggestion would be going via the mobile money operators. So that just, I guess, underscores the need for those who strategically want to remain in the customer-facing space. You're going to need to position yourself such that you have some portion of customer mindset and customer mind share going forward. Similar nodes are developing in West Africa and Southern Africa, as well as in Asia. We've got, for instance, in Pakistan, we're sitting in a position where Easy Pesa controls 89% of the mobile money market, and the mobile money market is 2.5 times the size of the banking market in terms of customer service. So one telco is servicing approximately 2.5 times as many people for financial services as the entire banking sector is in Pakistan. We need to get hold of that and regain control of the retail banking space reasonably soon. Nigeria and South Africa are outliers in the African context on this, in this regard, and that is simply because in Nigeria, the telcos were not allowed to do mobile money, so they haven't brought their marketing power to it. And in South Africa, the competition, the big four, are too strong. There have been multiple attempts to launch mobile money in South Africa, all of which have ended badly, simply because the big four are so dominant. And they've also, in the meantime, in the time since I did MTN banking way back when in 2005, then the only 40% of the population was banked and 60% was unbanked. We're now sitting in a position where the big four banks in South Africa have banked 70 or 75 or something like that % of the population. So it's a very different market now, and there's no real space left for new entrants. But that is not true in the rest of Africa, where the banks are still in low double-digit penetrations, or in many countries in low double-digit penetrations of their markets. Right, another poll. Would your organization need help to compete effectively in the A2F space? Yes, and there are 4 options up on the screen in front of you right now. No thanks, we're not under threat. No thanks, we are under threat, but we know what we're doing and we've got it covered. Yes, we have a plan but need help in executing it. Or yes, please, we'd like to make sense of our next steps in this field. How would you rank your organization on that list of 4 answers?
Thank you, Andrew. We're going to have the polls open, so please choose the best that fits your organization, and we will share with you shortly the results and take it forward from there. We're going to keep the polls open for another 30 seconds, and then we can close them and go ahead with the results. I guess we can close the polls now. We got all the answers. Okay, we have a good 50% Yes, please. We have a plan, but need help executing it. We have a 25 on no thanks and another 25 on yes, please. So, yeah, I'll take it from here, Andrew.
Yeah, okay, thank you. Great, good result. Yes, I mean, obviously at CapPlus, we are very interested in helping you guys to take advantage of digital. We believe in it, and we believe that we can most likely help you. It would be interesting to speak to you after this presentation. If it makes sense to you, we are very happy to discuss with you where you are and where we might be able to help you. Right, financial health in action. What I'm going to take you through here is an example of how financial health works. I would urge you to, while I'm speaking, I'd urge you to maybe, it's going to center around an example in agribusiness. But if you're not in agribusiness, try and generalize your thinking to say, what if this happened in a segment that I'm specifically interested in as a financial services sector participant? But first of all, let's recap again. Financial health is about leveraging access to finance digital infrastructure to better serve customers. It implies understanding and serving segmental needs of customers. So whereas access to finance gave these machines that can scoop up customers and load them on the back of a truck, if you like, almost like an industrial digging machine, we're now taking the tools that were used as an industrial digging machine and the customers that are now, if you like, loaded, and we're focusing in on their specific needs, and we're going to start tailoring financial products to the specific needs of a segment so that the customers become bound to those products. The product is now so useful to the client that he wouldn't dream of giving it up. This is going to entrench the market position of many of the players. It's also a real opportunity for a financial institution to connect with their market in ways which make you indispensable to the market. In other words, this is about bolting down. It's about customer loyalty, and it's about maintaining ongoing relevance to your customers. And it will eliminate things like price wars. It will eliminate things like one-off marketing campaigns that could churn a base, where we make ourselves so useful to the client that in fact we're part of the customer's life to the point where you'd never even consider discussing moving to another entity. So if we have a look at SMEs, SMEs have a big challenge. On the one hand, the cost of doing business in most countries is ironically enough, is inversely proportional to the size of the business, by and large. The large industrialized entities tend to have everything. They have choice of supplier, they have choice of banks, they have choice of input, they have choice of all the services they use. They're able to leverage all of that choice to drive down their input costs and improve their service. As we go down the economic group and we start looking at 1, 2, 10-man SMEs, suddenly you're dealing with a relatively small entity that has its choice is prescribed. It can no longer, it has to choose suppliers who happen to be geographically close or are willing to deliver to wherever they happen to be, based on a relatively small geographic reach. That means that they can't necessarily negotiate the best deal for themselves, in terms of growing their business. Juxtaposed to all of this is that in many countries, SMEs are the largest employers of people. They tend to be a very significant portion of the production in a given organization, in a given country, and yet they are in this difficult position where they are effectively being starved and their ability to make a profit is circumscribed. So the question is, what can digital do to help such entities? And for that, we're proposing digital markets as a solution. That is where we form a platform per vertical industry. And we gather around that platform all of the relevant suppliers. That could be the SMEs themselves, their financial services providers that wish to service those SMEs, input suppliers that provide the inputs that enable those SMEs to produce their outputs, service suppliers like accountancy firms and all the other necessary services to run a business, and the SME's own clients. What we're talking about is end-to-end value chain integration in specific industries in significant industries in a country where SMEs operate. This will enable the SME to access better working capital. It will enable them to do proper procurement across multiple service providers, informal support of their production, informational support of their production cycle, as well as digital sales and shared infrastructure. For instance, multiple SMEs using one accounting practice to drive costs down, etc. So how would everybody benefit from such an entity, from such an integration of an industry? The SME itself would gain cost-effective, convenient access to all of the inputs that they want. And this, we could suddenly start to remove the geographic aspect, because if we integrated all members of a specific industry across a country, suddenly it would become worth the while of a national supplier of inputs. And I'll take you through a specific example in agriculture on the next slide, to start to consider operating nationally with perhaps a few transport companies supplying them, something along those lines. The SME would also be able to, would therefore be in a position to introduce competition into its own supply chain. So rather than being bound to working only with the people that they can reach, because the people are within half a day's travel of where the SME happens to be sited, they could now start sourcing nationally, which allows them to drive down their input costs. They also have the ability, very interestingly, to cooperate with other SMEs in the same industry. Sometimes it makes sense for competitors to cooperate to effectively drive down their own individual operating costs, and all being on one platform would enable that. Obviously, I'm speaking to the financial services sector here. What's in it for you? What's in it for you is that SMEs are currently, although they're a very significant portion of many economies, they themselves tend not to be very well run businesses. Their reporting isn't audited in many countries. So from a banking point of view, the risks associated with lending to them and with operating with SMEs are relatively high. And in many clients of ours have said that, quite honestly, they try to avoid working with the SME sector simply because it's difficult to know what you're dealing with and to lend with confidence. But if they were all on a platform and you could see what they were buying, you can see what they are selling, you can see that they are trading every day, suddenly you have much deeper insight into the trading results of the SME, and puts you in a position where you would be able to make better loan underwriting decisions. Input suppliers. They suddenly have access to a large customer base of directly to sell their products. It also enables them, oddly enough, and I'll take you through this in the agri example, to ensure that their products are properly used by the SME in the SME's manufacturing process, in so doing ensuring a better outcome for all. The services providers get access to a market at low cost, and the SME's client suddenly has the ability to shop across multiple SMEs for the same product, thereby facilitating information flow across the entire industry so that the industry as a whole is more efficient. Which industries do we believe are prime for this? We see 4 industries. Agriculture, and I'll take you through an example of that on the right-hand side of the slide. Manufacturing, education, and distribution we see as the industries which would benefit predominantly from this level of integration. But on the right-hand side of that slide, I'll walk you through an example of how this might work. If one looks at a crop farmer, his overarching business process consists of deciding what to plant this season, planting it, tending it, selling the crop, and then harvesting and delivering the crop. That, at 50,000 feet, is what he does. Of course, there's a massive amount of complexity in each of those steps, but at 50,000 feet, that's what it looks like. So what could a digital marketplace do for him in that market? When he's deciding what to plant, input providers know exactly which seeds will grow in which areas are optimal for their seeds. Many of them have databases. Syngenta has a database of all geographic locations of where their different varieties of wheat seed will be most successful, for instance. So imagine if the farmer were able to walk around his own farm and use the GPS of his phone to say, this is my farm and this is how big it is. And then go to the market and say, right, which seeds would be best? And Syngenta and all of the other of their competitors could come back and say, seed type A, varietal B, whatever, is the right seed for you. And based upon your surface area, we believe that you need 100 kilograms of seed. And another thing, because the buyers are also on this platform, they too can turn around and they can say, we see a market for wheat this year. The market for soybeans is oversaturated. They can also see, and I didn't put it on the slide, what their opposition are growing. So they can position themselves before they plant for where they can sell their product. At the time of planting, they can do cost and time savings. They order their inputs on the phone. So once they've been told you need 100 kilograms of seed variety B, they can say, fine, I'd like to buy, that's exactly what I want. And I need the necessary weed killers, and I need the necessary diesel to do the planting, and I need fertilizer, etc., etc. Very importantly, and since I'm speaking to the financial services sector, this is your opportunity to grant him a loan in real time for these inputs. Of course, as things stand right now, you haven't got a history on him, but over 2 or 3 years of being on this platform, you will start to see who the successful farmers are, and therefore who the ones who are creditworthy. So you could theoretically arrange a loan for him for all of his inputs right here, right now, and in fact pay the supplier on behalf of the farmer for the delivery. The goods are then delivered to the farmer, and the farmer authorizes you as the bank to release payment to the supplier. Because Syngenta knows where this guy is, they've got access to the global weather reports, they've got access to, they know exactly under what circumstances the seed grows best. They can tell the farmer, do not plant until next week or next month or something. They can give him guidance on when would be optimal for him from a germination point of view to plant his seeds. Tending of crops. Many of the crop suppliers also, these seeds are highly hybridized, and they know roughly what sort of growth cycle you're looking at. They also know the day that the guy planted, so they can send him a message. And in fact, they do this in China already. They send out a photograph to the farmer 6 weeks after he planted that says, all of your plants should look roughly like this. It should be about 6 inches high. It should have 2 leaves that look like this. If they don't look like this, please contact us. And the farmers take photographs. Those whose plants are not looking good take photographs of those plants and send them back. And based upon what the leaves look like, the seed manufacturers are able to say, oh, yes, it's got ABC disease. And by the way, you need to buy this to kill that disease. And in so doing, they can help the farmer grow the best crop he can, given his input costs and the inputs that he applied. Comes time for selling. The buyers already know, because they're on the platform, which farmers are growing what. So they can actually know where they can source it. They also know more or less when harvest time is going to come. So the market itself is able to self-regulate based on all the knowledge of what is being produced. And they will then be in a position to make offers. So they will, rather than the farmer having to approach one takeoff agent, multiple agents can come to him and say, we know that you're going to have approximately 6 tons of wheat in 3 months' time. We make you an offer of this for it. And by the way, we know that it's good quality because we've seen the photographs of the plant. They can also, of course, so that's how that is how the platform could guide the selling of the crop. Comes time for harvesting, the farmers could syndicate with other wheat farmers, because they can go look on the platform and say, which of my neighbors is also growing wheat and is also about to harvest. And maybe they could syndicate on a harvesting machine, hypothetically, and rent one for a day and share it between them, because these guys tend to be small scale farmers. But once you aggregate a few farms together, you could probably between you rent a harvester. Same too with transport. Because it's the same product, you can cluster. The farmers can cluster. So instead of as is currently the practice, the buying agents tend to discount the goods if they have to come and collect. This way the farmers can group together and rent a large truck and go from farm to farm, load it all up and deliver it. And in so doing, not have to discount their product to basically offset an input cost. And discounting your product is probably the most expensive way of financing your inputs. So that is how this whole industry works together. And by the way, when the truck arrives at the buying agent can disperse payment directly to the phones of all the farmers, enabling the farmers to repay their loan right now. And you as the bank will be part of it. You'll see it all happen, so you'll know when the farmer has money. This is how information will make the participating banks, the participating suppliers, the participating servicing agents indispensable in the lives of this one grain farmer that I've spoken to. And of course, the same applies to manufacturing. And of course, the same applies to education and to distribution. So it's a matter of where the emphasis of the bank is as to which of these hubs you would want to participate in. So what happens? The markets are impacted. The market efficiencies are created by sharing all of this knowledge. This leads to increased profitability of the lower income participants by supporting them to basically behave like organizations which are much larger than they are. The operating margins that are thus created can then be applied by the SME to do one of many things. They can either take more money to the bottom line, i.e. a larger profit take for themselves. They can employ more staff and expand their business, or possibly rent an adjacent field and grow some more next year. Or they can simply use it to create a financial buffer for future supply and demand shocks in their lives. So what does this mean to the banks? This means that we're going to formalize what is currently a fairly informal market and is inaccessible to the banks at the moment. Or many of the banks that we've spoken to have mentioned that they have very limited appetite to lend to small-scale SMEs because there's little provable evidence of their trading results. Suddenly, all of this becomes very possible. And big data will allow you over time as a bank to build a trend and a behavioral pattern for the farmer, which will enable you to be able to separate the good ones from the bad ones and obviously lend to the good ones on the right kind of rates, etc. Therefore, we're hoping that this will catalyze investment into these economies. So feedback. Does your organization need assistance in exploring how financial health could work? Of course, it can work in the SME segment. It also works in the consumer segment, where we could tailor specific financial packages for specific consumer segments, such as the youth market, for instance. So yes, I'd be interested to hear your answers on these.
Thank you, Andrew. We'll take the answers on these and we'll discuss them later, but to mention that in any case, please free to contact us if any support is needed after this webinar. If you have more questions specifically for Andrew, we can let him know and we'll take care of that. So we're going to provide you with our email address and you have our contact. Please feel free to contact CapPlus for any ideas or any support you might need or more questions for Andrew. And we're going to be closing the pool in like 20 more seconds. So we can just discuss results of this and then we'll take it forward. I say we can close the pools now. So yeah, we have good results. Yes, we will need some help, or please contact us. So we can take all those forward later and we will, I'll give it up to Andrew because there is not so much time left. So I don't want to take more of his time.
Okay. Thank you, guys. Those who've said please contact us, we will be contacting you in the next couple of weeks, basically to see where and how we might be able to help you. All right. Are there any questions, comments, queries, anything you guys would like to know about either the access to finance or the financial health aspect? happy to discuss.
Yes, please, everyone, if you can just write your questions in that small chat box. We just put that please enter questions if you have any, and Andrew will be happy to discuss any of those. If anyone wants to just have us unmute you and you want to talk directly to Andrew, we can also do that, whatever makes you more comfortable. So yes, we're here. So basically the Q&A is open. So please feel free. We have a first question, Andrew, until I will start with this until I receive any other ones. You just gave an example of basically of a marketplace with a lot of players.
Yeah.
Who do you think should own this marketplace and who can create this marketplace?
Okay, these marketplaces are best owned outside of the participants. The reason is that you will appreciate that every single one, let me scrub that circle. Every single one of these participants, including the SMEs, everybody around this group has competitors. So ultimately, in the 10-year vision is that all of them own it and run it for themselves. However, to catalyze it, it normally makes sense for a technology firm or something to start it. Under guidance, we ourselves play a facilitation role. We pull the people together. It's best done when we say to everybody, puts self-directing and acts in the interests of the entity has, but I can cite an example of some work we're doing with another NBF, with a small microfinance organization. They've effectively decided not to get a deposit-taking license, so they will remain a microfinance lender. So what we're doing with them is we're using digital to extend their footprint and drive cost out of their sales and marketing structures. Some microfinance organizations have indicated to me that they spend roughly 18% of the cost of the loan sourcing loans. Our intention is to get that well below 10. So effectively, we drive cost out of your business if you decided to remain a pure microfinance lender, so that you are more flexible going forward. You're obviously, if you're in a market where you have a mobile money player and they're driving through their back act, digging up the market simply because they have the reach and the spend, you yourself would probably act as a niche player. You'd need to choose one market segment that you really want, and we could probably build some sort of financial health package around that segment, and link your agents and your product and your product delivery specifically to that segment, so that you can home in and specifically work, for instance, in this example, on wheat growers as a target market, and only focus on them, so that you don't have to compete with the guys who've got, for want of a better word, mechanical shovels, picking up all the consumers in the market.
Great. Thank you, Andrew, for your answer. I'm waiting for more questions. In case I do not get another one, I'm just going to wait a bit more. Do you have any extra examples that you want to share, or any other comments that you want to make in this time? 'cause because I haven't received a question yet.
Okay. No, I mean, really what it comes down to, guys, is that, as I said in my opening slide, digital is both an opportunity and a threat to you guys. What we strongly urge is that you guys engage with it. You're going to have to. Your market is engaging. It's happening out there. The question is, how do we equip? What we like to do is put you in a position where you are able to leverage the advantages that it offers you. So I guess there's no time like the present, I guess, is my golden message in all of this. Jump in and compete, because it's about market consolidation. If left to its own devices, this is like market consolidation. This is going to do to retail banking what Amazon has done to retail in the rest of the market, where effectively high street in the UK, high street shops are closing one after the next because Amazon basically can undercut them, because they've got two things. They've got lower operating costs because they are selling out of a warehouse, delivery vans, and they also have much more reach than a high street retailer. So they can sell to more people off a lower cost base, and so their products are cheaper, so the market moves to them. It's a virtuous cycle. The same is going to happen in retail banking, and we urge you to position yourselves so that you're one of the people who benefits from it. Really, is what we're saying.
Thanks, Andrew. So I have one more question for you.
Yes.
The question is that in the graphs, active user rate seems very low. Has there been progress in improving those rates in the market?
The active user rates in Kenya are 67% of mobile money. So that means 2/3 of the base use it every 90 days. Financial health is going to change that completely. Because when you start contextualizing these services, remember, are one size fits all, just go for it products. In other words, yes, you can remit, yes, you can pay your satellite TV, yes, you can remit money to your mom from Nairobi to where she is in rural Kenya. And now, by the way, you can remit to her to your aunt in Uganda as well. But financial health is going to drive those numbers way up. Because effectively what they're now going to do is they're going to go back and say, okay, we've got grain farmers. Part of what we've got is grain farmers. So whereas before the grain farmer would do his whole commercial transaction offline and then take some of the money to an agent, deposit it into his phone and send some to his mom, he's now going to move his entire production cash flow onto his phone. So that 67% activity rate is going to go way up for that one segment. And as financial health is rolled into more and more segments, so that's going to expand, which is why everybody needs to be part of this thing as early as they can be.
Great. Thank you, Andrew, for replying to this other question. Since we do not have any more questions and we are almost done with our time, we want to thank everyone for participating in this webinar today. Thank you, Andrew, for leading this and being with us. And you will hear, to all the participants, you will hear from us very shortly. And we hope to talk to you again soon and to participate in more webinars upcoming. Again, thank you, Andrew.
Great. Thank you very much, guys.
Bye.
Bye.